Well, g'day there traders and friends, market enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down and bring you the first market update for the year 2016. This is also the first market update which I have done publicly on YouTube for the better part of about a month now. It's been a little bit of time. The reason why is because the market itself has been topping throughout the months of November and December, and for the entirety of those 2 months, it more or less moved sideways right up until the past 1.5 weeks. As we've transitioned into 2016, the markets have moved into a nosedive. The Dow Jones Industrial Average this week closed down just under 1,100 points. And if you have a look at the daily volume, there are a lot of people selling, distributing their positions in the marketplace, just as once again the market has come back up and retested this primary trend line. Now, before I move into the market analysis this weekend, I'm just going to provide you with some form of a syntax as to what I'm going to go through or transition through maybe over the next 15 to 20 minutes. If you want to make yourself a cup of coffee, maybe a cup of tea, get settled in because, again, there's a lot to learn based on what these markets are doing. Technically, they are working brilliantly. A lot of people in pro over the past 2 months have been using this time as an opportunity to hedge their portfolios, if not move net short on the market, just as long as the market itself didn't break above this primary trend line. As we expected, it held as resistance. And a lot of people in that pro analysis class not only have long-term hedges on the market as we have established the first legitimate lower high on the macro trend. So we have transitioned from a primary bull market into the beginning of an early stage, or the early stage of that of a bear market. They've not only hedged the market and moved net short, or at least hedged their portfolios, but they've made a lot of money and a lot of percentage returns trading our top 12 individual trade lists. The beginning of 2016 has been an absolute goldmine for people in that pro analysis class. What I'm going to do is reference some of these individual trades, if not all of them, and just go through the entry points and the targets, and just to show you some of the trades which we have opened really late last week, if not the first trading session of this week, Monday, as a lot of the individual stocks broke down. And then I'm going to go through the analysis as to why you need to be very careful having long exposure in this marketplace, or looking to buy any potential dips which do set up throughout January, and maybe even as we push into February. I'm just going to show you some of my concerns. So again, this is probably going to be a little bit of a longer market update. I haven't done one in quite some time, but look, if you've been following me on YouTube for however long you have, you can see the documentation of this analysis for the entirety of, or since the August and September lows. I've been calling this the slope of hope rally. And again, I was under the assumption that we were going to set up the first lower high. That appears to be evident. We've cracked the neckline. The market itself is, again, in a bit of a tailspin. It's selling off. It doesn't know where support is. And if you can recognize this through technical analysis, you can really position yourself to make a lot of money in terms of, transitory markets, and establishing, or at least building a position for a long-term hedge in the event that this turns into a full-blown bear market. Let me just give you a quick update on some of these individual positions first. Apple this week, we had a short below 103.64, and we hit our target down here at $97.72 on Thursday. As a matter of fact, we started shorting Apple up here at 115.41. So you can see, if you take into consideration the entirety of this move, it's close to $18 on about a $120 stock. So, it's very close to 20% return in the space of about 3 weeks just trading the equity. If you're trading put options, that just gets blown out of proportion. The leverage of those options really opens that up into quite a windfall in terms of that Apple short. Boeing Airlines this week broke down below 138.66, and I must admit, I'm trying to be as humble as possible. I am a very humble person, but the writing's been on the wall for a very long time on this market, and those privy to pro, again, have really been able to position themselves to take advantage of this little sell-off which we're seeing in the market. 138.66 was the short. We hit our first target at 134, and we're on our way to our second target down here on Boeing Airlines at 127.57. Baidu was another short at 186.50. We gapped down on Monday, so it ate into our entry price a little bit. But here we are trading down at 171.34, making our way down to 166.65. Caterpillar was an absolutely beautiful, poetic short. 67.40 was the entry, and we hit our target on Friday at $62.97. Another $5 of intrinsic value into those put option contracts. CVX was short at 88.05. We hit our target at 82.23. You can see how all of these trades are coming together. Google again is on the precipice of breaking down. It's here at 7.32. It closed at 7.30, so we're only up a buck or two on Google, but I mean, it looks as though it's about to break down and move towards that 700 figure, if not a little bit lower, to close that gap. Goldman Sachs, I sat on the sidelines for 179.72 was the initial short. Again, we gapped down on Monday, and then we broke below our second entry at 172.24. Here we are at 163.94, so another very, very profitable trade. IBM short below 136.78. Here we are at 131.63. I mean, I really don't want to rattle on about these trades or this past performance, which we've seen over the past week. But again, people privy to this class have seen this coming for not only weeks, but for months. We've had to be patient. We've had to remain disciplined as the market moved into the festive season, where volatility and volume really got sucked out of the market. And again, it moved stagnant sideways. But again, the vote of confidence in this market as at the first trading week of January, or really, the first quarter of January has really been a vote of no confidence in these high prices on the equity markets. Tesla, 234 was the short, and here we are trading at 211, target 206. But again, lock in your profit and just make sure you bank as much of that profit on that individual trade as possible. And to surmise or to finish the individual trades, we've got Walgreens Boots and Alliance short at 84.71, and we hit our target on Wednesday at $79.46. Why am I going through the individual trades, and what does this mean for the equity markets? For the past 3 weeks, I've been saying this market is an absolute gift for those who want to recognize that and take the opportunity to hedge the market, or at least take out longer term positions on the DIAs in the way of buying put option contracts. If you want to trade the Qs, that's fine. The QQQs, they're zeros, but I'll turn them in the Qs. Or even the SPYs. Take it or leave it. You had the opportunity. And anyone who took those positions on in Pro are really laughing to the bank at this point. Now, again, trying to remain as humble as possible. We've seen the writing on the wall for quite some time. Not only has the Dow Jones Industrial Average been stagnating, in that upward range, or was in that upward range between 17,100 and about 17,750, we had the transportational average really show us some very strong divergences. So if I bring this up, and this is just a line chart, the purple line here is the transports, and we had the industrial in the dark line up here. At one point in time, there was a very big divergence. The transports were tanking, the industrials were just hovering water, and one of these markets was telling us fibs. Now, generally, according to Dow theory, Charles Dow, one of the tenets, of course, is that when these two markets diverge from one another, it's only a matter of time until they start to converge, i.e. that the lines themselves move back together. Now, here we are as at the close on Friday. The industrials have turned down. They've closed at about 16,346, but the transports are all the way down here at 6,946. So they've closed below that 7,000 level. And if you look at how far potentially the Dow Jones still has to drop, I'm not saying that it will drop this low, because I believe that the market itself is going to establish a higher low over here and sucker in the last dip buyers relative to August and September. Well, potentially we have lows as low as 15,500, maybe even a little bit lower, which would push us beyond that August 2015 low. Now, again, Dow tenets, or tenets of Dow, in and of themselves, they help us understand where direction and where momentum may be moving to, but it doesn't give us the full, aspect or perspective, the prism of which we evaluate and look at markets in, all right, as technical analysts. Now, again, the Dow Jones Industrial Average closed down just under 1,100 points on the weekly chart, on the weekly chart, the past 5 trading sessions. There's a very good chance, and I want you to understand this, everyone on YouTube, and I made this very clear in the Pivot Point Pro analysis class, which I've just recorded and is up on our website. There's a very good chance that this market doesn't overshoot August lows, and it may not even get as low as the September lows as well. It wouldn't surprise me to see the market more or less come back down to, 16,100. It may even turn on a dime over here at 16,300. Somewhere between this, or in the perspective, or in the position in this red box, is where I expect the market to turn and to bounce. The problem with this bounce, however, is that it's not going to be sustainable. Right now, as I look at price, we're below the 100 and the 200 simple moving average. We've been sort of moving back and forth. At least the 100 has held as long-term support, but every time we've moved above the 200, it's just been another great shorting opportunity or to open up short positions. I myself have been very open about this, and I've been accumulating shorts up here, ever since we turned down in the month of November up here at 17,633, and simply just rolling the contracts over just so I have exposure to the downside. Other people shorted up here about 17.4. We even put a little a red box up here during the festive season to say, hey, if we see a reversal, this is it. And that's exactly how it played out. The reason why I'm going through this is because when we see price break below the 100 and the 200, generally bad things happen. On top of that, the exponentials, you can see the cross which we've just seen. We've broken the structural support. We've established the first lower low, the macro lower low, and of course the macro lower high. This is the essential beginnings of a transitory shift from that of a bull market to that of at least a consolidation or sideways market, if not an all-out bear market. On top of that, if I change to, again, these oscillating indicators and show you some of these long-term macro sell signals, if I take these annotations off my screen right now, if I change to the monthly chart, you see the MACD. Now, the MACD is the strongest of these three momentum indicators. If you go back to 2008 and you go back to 1999, to the year 2000, the turn of the millennium, they were the last two times where the same signal has been generated. Now, you can see what happens after the long-term momentum of the market shifts. Here we are midway through 2015. It began to turn, and it looks as though we're setting up some form of a double top on the monthly chart. This is a huge problem. Now, taking this one step further, if I change to the monthly, so let me bring up the right, settings over here. If I change to the weekly and bring back on my annotations over here, when we have a look at the exponential moving averages and we change to the weekly, as soon as the 10 crosses below the 20 and crosses below the 50, bad things happen for the stock market. So not only are we seeing this come together on the monthly chart, we're seeing the establishment of the lower low and the lower high and the back test multiple times of the primary bearish trend. It looks as though the primary trend of the Dow, the S&P, and the NASDAQ has now moved into a bear market, or at least the beginnings of a bear market. And I'm being very open about this publicly on the YouTube channel. I need to share this with you because it may save you a lot of money, but also make you a lot of money if you take this opportunity and you're not resistant or apprehensive to change. As a technical trader, as a technical analyst, it's very easy to change positions or to set up different order types. It's not all that hard. You just have to embrace change and recognize it for what it is. Right now, we've got all of the telltale signals that this market has shifted. The sentiment, the psychology of market participants, the institutional money has been shorting this market up around the highs. It's been a period of distribution, and now it's starting to break down. Not only that, if I show you the weekly chart of the long-term primary trend on the Dow Jones Industrial Average, the third fan line, which appears to have broken, or it has broken throughout the August sell-off, has come back up most recently, and it's now back tested the primary bullish trend line. So this is a bearish retracement and a bearish pullback and a bearish retest, and now it's starting to roll over, and you can see again the establishment of the primary trend line. Markets unravel very quickly. They unravel much more quickly than that of a sustainable bull trend. Now, again, there's going to be a lot of noise out there in the media if, in fact, the Dow Jones does turn on a dime somewhere in this location and it starts to rally. All of these long-term simple moving averages, the exponential moving averages, the weekly 10 simple moving average or the weekly 10 exponential moving average, they are all going to act as resistance. So in the event that the market does rally back up into this red box, you need to not buy into the complacency, to not buy into the buy the dip mentality. It's going to be most likely the last opportunity to have a hedge on this market. Now, as I sit down and bring you this recording, I'm not even sure if this market is going to have the strength to rally back up into, anywhere up until really 17,500. It's a really big what if at this particular moment. We may just sell off and break below the August, September lows. I think that is highly unlikely during these intermediate shifts in the primary trend. So we have the, the intermediate movement working in conjunction with the primary trend. Generally what will happen is we'll come back up and we'll retest old support as new resistance, and this is where again the supply will overcome demand. Everyone who has bought throughout October, November and December is underwater, and they'll start flipping out their positions if in fact they can break even on those very same trades. It's just simply the psychology and the sentiment of market participants taking place right above or right around this level. For the entirety of 2015, the market itself held above this 17,154 level until August. So all of this is overhead supply where people in Main Street who haven't distributed their positions or at least sold their positions are going to take it as the final opportunity to get rid of them, and that will form the back test, which will ultimately drive this market back down to lower lows. This YouTube update it's not here to scare anyone, and I've made that very clear in Pivot Point Pro. For the past couple of months, I've been outlining this market very clearly and saying, look, you just need to adapt with the market as it changes. It's nothing more than cycles. Cycles play out not only in the market, but they also play out in life, and you just need to adapt to them. Those who adapt and those who've taken this analysis to heart and have hedged and have also placed those individual trades are up. I'm not going to put it in percentage terms, but in terms of 2015 gains on the market, we're up over 10, if not 20 times in the first trading week for all of the gains for the year 2015. And again, I don't say that to come across arrogantly whatsoever. I'm trying to help you. I'm trying to help you understand what's going on with the stock market and to not be afraid of it. You don't have to panic, so to speak. You just need to understand what's going on and how to position yourself and how to trade a potential bear market. Any opportunity that this market rallies now is going to be an opportunity to liquidate longs or to take on hedges, i.e. to position yourself short, to offset some of the losses which you're going to incur, either holding these trades long term if you want to take that risk, take that gamble. It's really going to be an opportunity to sell at that declining 50 exponential moving average, or even if the market gets back up to the 200 simple moving average, which I think at this particular moment in time is going to be a very long shot, a low probability, and really asking for a lot from this market to be able to push back up into this level. Now, it may do that, and again, if it does, I'll just simply add to my shorts. But as at the close on Friday, I haven't closed out any of my long-term positions. If anything, I'll add to them when the market bounces. And the reason for this video, again, is because the market is telling us which direction it wants to move. Momentum itself is breaking to the downside. Don't fight the market. Never fight the market, okay? You just trade in the direction of the momentum, and the momentum on any time frame which you look at. I mean, if you want to go more molecular than the daily chart, that's fine, sure. Maybe on the 5-minute chart, we're incredibly oversold. It doesn't really count for much, except if you want to trade intraday. We are swing traders. We look at the daily, we look at the weekly, and we find out the macro trend on the monthly chart. All of these cycles are down. I'm telling you right now, all of these cycles are down. And if you're sitting here hoping for the best, you should really be at least, preparing as a long shot for lower prices in this market. It's hard, first of all, to completely have a clear view as to what's going to take place over the next, 2 or 3 trading sessions of what will happen next week. But we have these areas, these critical areas, pivot points, which will guide us in our decision-making process. So this is a very important YouTube market update. This hasn't come as a surprise to anyone privy to Pro. I'd recommend you to join that class. People in that class have paid for that class, some for an entirety of their lifetime, if not others definitely for a couple of years. And if you want up-to-date information throughout the entirety of this role, this transitory type of market, which we're starting to transition to, if not, we're really starting to sort of pick up the momentum and the snowball, so to speak, is really starting to accumulate as it rolls down the hill. You should really jump in there and learn a lot about stock market trading, because the signals themselves are very, very clear to those who are trained to see them, okay? And I'm sharing this with people in that class. Everything I know, I'm sharing with others, and they're doing very well from it, all right? 2015 was a very, very frustrating year. The market itself just more or less moved sideways. It was highly volatile, back and forth, and it looks as though, again, if you go back to previous YouTube updates, I've spoken about the potential of a left shoulder over here, the potential of 2015 or the majority of it being ahead, and now the potential of the right shoulder. I've been speaking about this since the August lows. All right, and you can go back and watch these analysis videos on the YouTube channel. Outside of that, go back and watch this, this piece of analysis which I did. I think it was probably 2 months ago. It was called, Stock Market Repeating Itself, Boom Bust Cycle. Okay, and it compares the current market to the 1960s and the 1970s, which I find absolutely fascinating. A lot of people are interpreting on the monthly chart for this being some form of an expanding top type of pattern. And, people have these really crazy projections on price. Now, I'm not buying into these crazy predictions of, Dow 6,750. What I am saying though is that the signals themselves, no matter which cycle you look at them on, are bearish. And because they're bearish, you have to operate in a bearish mindset as a trader. People who are going to buy these dips are going to be forced to sell as price moves beyond their initial buy prices, and they simply need to cut positions. You need to be on the opposite side of the trade, and I walk you through this each and every Saturday in that pro analysis class. So I mean, it's up to you if you want to take the market on. If you think you're experienced enough, that's fine, go for it. But there's no better time to be, working with people who are doing very well for themselves during this transition and are happy to share with you as well. And I'd really encourage you to take that up and at least to hedge in this market, because it's not the time to be sort of hoping and praying for the best and having no insurance policy on the market whatsoever. Because again, if you have a look at the weekly chart, it didn't take all that much time whatsoever to revisit these lows, very similar to the August capitulation which we saw, which rattled a lot of people. Unfortunately, I don't think the panic and fear has set in yet, and it probably really won't set in until we break the August lows. So we go through these tipping points, right? I said in the weekend video, this was tipping point 1. A lot of people are taking notice of how many trillions are getting wiped off the equity markets at the moment. And again, they're sort of on edge right now. They're saying, well, what do I do? Do I hold onto these positions and think it's going to continue? But that sentiment or that psychology is going to shift when we get to tipping point number 2, if in fact the market can get up here. And then of course, if in fact this level does break, we'll have to evaluate it as the market continues to move. But if this point breaks down, just shy of 15.5, that's where you see, crashes. That's where you see panic and fear. And the best way to position yourself is to be ahead of the herd, to recognize it before it happens, and to have that insurance policy set up in the event that this does happen, and you're not one of those people scrambling to sell your position when there's absolutely no buyers out there in the market. That's when you see bottoms fall out of stock markets. I'm not saying it's going to happen this week. It's probably, if in fact it won't happen until mid-year, based on the the technical picture and how all of this sets up. But again, I wouldn't be taking anything to chance at this particular moment, because we haven't seen anything like this develop since 2011, and 2011 was a false signal. The difference between now and 2011 is that we've established that macro lower low and that legitimate lower high, and now price action is below all of the the bearish resistance levels on many different time frames. And when we get into these positions, which is very, very rare, the last time we were actually in this position was 2008. When we pushed down below all of these resistance areas and the trend started to get moving. You don't want to be a person starting to fear or start to panic in the event of a sell-off. You want to watch it coming and have positions open so that you can sit back and just watch the market and not have to stress out and lose sleep over it, wanting miraculous good fundamental data to show up. You don't need to know any of this stuff. You just need to follow the technicals, because the technicals are king. Price action is king. Price is what pays us, all right, as technical swing traders and even fundamental traders. But the global picture is really in a bit of a tailspin. It's disintegrating. We are moving, or we haven't seen economic reports as bad as what we're seeing, unless factually speaking technically the US has been in recession in the past, and we've seen some indications at least of where we currently are, where in the history of finance the US hasn't escaped a recessionary a recessionary sort of cycle. So I mean, that's where we are at the global marketplace right now fundamentally, and it's tying perfectly into the technical picture as well. So if you can recognize this and position yourself, you don't need to be afraid of it whatsoever. So I'm going to finish this weekend's market analysis like that. I've got a lot more to talk about, and again, if you're privy to pro, you've got maybe 3 months worth of backdated videos online, which you can go back and you can just see my entire thought process throughout this period. But again, a lot of people were saying this slope of hope rally, which I was talking about, is just untrue and false. And I mean now just look what's happening. I mean, the price action speaks for itself, and I really rest my case in everything and anything I've said, really for the entirety of my, posting these YouTube videos as well. So I mean, it's been a testing period. We've had to really remain patient. But again, we're just dealing with some of the ramifications of what's happened in the past in the year 2016. And I'm not sure if it's going to completely unravel, if there are going to be any sovereign debt defaults, if we're going to see any of this junk yield really spike higher. there is a lot of pressure around the world, and again, emerging markets borrowing so many dollars, US dollars, and seeing their own economies collapse because of the commodity deflation, and trying to service the interest repayments on, of course, a lot of these loans which were taken out post 2009. It's all starting to bite. A lot of emerging markets in the butt. And of course, you have the China contagion, which no one really knows, no one can really put a finger on as to just how bad it really is, based on, of course, the governmental or the Chinese government reports, how factual and true they really are. So, I mean, there's a lot of uncertainty in the market. And when there is uncertainty, also moving into a presidential cycle as well, generally history suggests, I think, one out of the past 5 presidential or second term cycles, when we go up for election, it has been a negative year. So just be mindful of that. And this is just history. Again, history and cycles repeating themselves. And it's just psychology playing out of market participants. People are fearful. They're not panicking yet. But when we get to that tipping point, which will be very soon, probably some point early 2016, maybe in the first quarter, again, you need to be prepared and prepare for what could be a pretty tumultuous 2016. So, outside of that, friends and traders, I didn't want it to be all so doom and gloom at the moment, but I mean, I've tried to keep this market analysis privately, in pro as neutral as possible, but I've even walked through the process with people in that class, and I've really just outlined it. Hey, there's really no reason whatsoever to be bullish on this market at the moment based on the technicals, and as such, we're being very handsomely rewarded, by the market and by price. So, outside of that, it's something to ponder, something to think about. I hope this analysis and me talking to you has it's been somewhat beneficial. Have a fantastic weekend, everyone. Again, be prepared for that higher low. I get that terminology or the jargon mixed up all the time. A higher low, and don't buy into the complacency. Don't buy into the noise. They'll start saying, look, we have a low in August, we have a higher low in September, and we've got a third higher low in the month of January. Everything's okay. If you find yourself buying into that mindset, quickly reevaluate it, because again, a lot of people are going to get found out when something like this happens. This may be the first wave of a 3-wave cycle down. We'll just have to see, okay? But please listen to what I have to say. Rewatch this video a couple of times. Share it with people if you care about other people and you're starting to see this for yourself. But yeah, outside of that, everyone, have a fantastic weekend. Enjoy your weekend, and I look forward to the trading week upcoming, okay? All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Goodbye.